More and more people seem to be questioning the data that is and has been coming out. And in today's market update, we're going to take a look at some pretty convincing evidence as to why what we are being given for data may actually be manipulated. That's coming up right now. Hey, thanks for joining me today. I'm Rick Harrison with the Home Sold Guarantee Group at MVP Realty in Southwest Florida. And on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome. And if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news, keeping you ahead of the market trends. After last week's housing and economic headlines capitalizing on the fear with titles using crashing, cratering, and similar doomsday words, this week we're turning our attention to the real meat and potatoes that matter in the outlook of the economy, and that is the data that we are being given. So, in today's update, I'll be diving into some stories that are showing that mainstream is finally catching up to and admitting to things we've been saying all along. And make sure to stay to the end where I'll go over a pretty compelling argument for data manipulation across the markets. But first, let's quickly look at the changes here in our local market of Southwest Florida. All right, so let's get into this week's local market update. Start off with the southern part of Southwest Florida, Cape Coral to Naples. New listings went from 786 last week to 683 this week. That's down 14%. If you remember from last week's video, we actually were up 14%. So we really just changed hands this week. Solds went from 576 to 608, so that is up 5%. Again, sold is a lagging indicator. That's indicating what happened 30 to 45 days ago in the market. And then pendings, which is your leading indicator, went from 772 last week to 783 this week. Really not huge change, up about 1%. But again, not very large change there. Price decreases also were up just about 1%. Really nothing to talk about here. So overall, for the southern part of Southwest Florida, not a huge change in the market conditions from last week to this week. For the inventory breakdown, single family homes went from 49.94 last week to 49.73 this week. That's a decrease of 21 units for single families on the market. Condos, which is everything else other than single families, went from 21.53 to 21.27. That is also a decrease of 26. Not huge numbers here, but still a net loss of 47 when we compare it to last week's net gain of 73. So as you can see, over the last couple of weeks, we've been seeing the market as far as inventory has really been kind of balancing out and hasn't really been hitting any new higher highs. Multifamily last week, 187 down to 174 this week. That's a loss of 13. And then foreclosures, 47 last week to 45. That's a decrease of 2. So again, not a huge change in inventory or what's going on in the market conditions for southern part of Southwest Florida. Moving on to the northern part of Southwest Florida market conditions. New listings last week, 1772. This week, 1617. So that's down 9%. That is a pretty decent decrease in new listings. Solds went from 1549 to 1628. That's up 5%. Again, that's a lagging indicator of last month. And then pendings 2006 to 2036. Really not a huge change there, up 1%. Again, we have seen that the interest rates did come down a little bit. They are not on the 6% highs that we've seen over the last 2 months. They are down to about the 5.5% mark. The big thing here is that the price decreases, 23.77 last week, up to 28.39 this week. That's up almost 20% week over week. So that is a story we have been seeing happening more often across the country. When we look at the inventory breakdown, single families 40.85 last week, 40.47 this week, loss of 38. Condos 13.97 to 13.86, a loss of 11. So both weeks really we're seeing a pretty consistent loss of around 40. If you average that out, it'd be right around 40 to mid 40s losing for inventory week over week. Multifamilies, really not a huge change. We lost 1 from 78 to 77. Foreclosures, 33. We actually gained 3 here, 36, which is a different story because we've been seeing it really fall week over week for the last, 3 to 4 weeks now. With foreclosures, more people have been buying them than have been actually staying on the market and active. So I think that's a good indicator of what's going on with the market. People are kind of nervous about buying anything right now. Even the investors are looking at the market a little skeptically. So we'll have to see if that continues. As far as interest rates go, we did see the interest rates kind of return back to where they were about 2 months ago, 5.5%. We went from 5.1% to 5.5%. Again, this is really indicating what's going on with the bond market and more specifically the 10-year bond. Also, bank rate had it going from 5.4, which is around the 4.5%, up to 5.87. So again, pretty consistent, around 40 basis point increase. And these are, again, just national averages. So you may be able to get much better rates, particularly with a local lender or somebody who maybe even a larger lender, a national association like mortgage wholesalers. For the headline highlights, we're going to go into the stories for the day. This is really just an overview of what's going to be covered in today's video. But let's get started with the first story, which is actually the Realtors, Florida National Association of Florida Realtors. So realtors and clients see market changing. We've been talking about this for quite a while now. We're a little bit ahead of the curve. It's better to be ahead than behind, I think. But again, South Florida, many sellers still want to list their home at the high end, but they're also starting to understand the new rules with this changing market. Again, we are seeing a rebalancing. So that is going to really determine what happens with sellers and how they can price their homes. It's still a seller's market, as I've been saying, but the agents are starting to stress more that it's not the torrid of 6 months ago or even a year ago where bidding wars were common. Homes flew off the market in a matter of days and buyers waited inspections just to get into a home. All of that has really changed. So some of the things to really consider if you are considering selling your home, pricing the house correctly. This is kind of the number one rule. Even if you think you can get more for your house, you need to price it where the market is, because that is going to, if you overprice it, it's going to sit. And the longer something sits, especially a house, more and more people, even if there's nothing wrong with it, more and more people are going to say, oh, I wonder what's wrong with that house. They're going to bypass it. They're going to just not even look into it. So it really is part of it is psychology. Despite the record high housing prices, it's crucial for sellers to price the home based on what it's worth, not the prices they felt they could get at the peak of the market. They might want to price it at $685,000, let's say, but the real price should be $650,000. Overpricing at $35,000 could be the difference between getting an offer and not. Some people are not even, most people I'd say, are not even going to want to put in an offer if they think that it's way overpriced, because they think the person pricing it is unreasonable and is going to be expecting the world. And right now, that's just not where buyers' heads are at. They're willing to wait because they know that things are already changing, and they're willing to wait a little bit longer to really see those prices come down. Don't expect bidding wars. Something I have been mentioning to most of my clients, and that's really been kind of the trend that's been happening. Sellers grew used to those bidding wars during the pandemic boom as buyers eager to land a home and facing stark competition would bid up the price in order to win a home. We were seeing 50,000 in some cases, depending on the price point, 100,000, couple 100,000 over price just to win. That's not the case anymore. So be on the lookout for that. And then also, really setting up your house and making it more marketable. So whether that means staging, it doesn't have to be, professional staging, but you really do need to put some effort into making your property look, appealing to a buyer now. So as the housing market took off, most people were, they didn't have to negotiate with buyers. They're willing to waive certain contingencies. But now that shift has happened or started to happen, the buyers now are starting to have more power in their negotiations. So as a seller, you need to understand, you're going to have to pick your battles, when to bend and where to bend. Things like inspections are becoming more and more important for buyers, especially as they feel like they are buying in the top of the market, and sellers probably know that they're selling at the top of the market. A lot of buyers now will just walk away if they don't feel like it's a good deal for them. So moving on to the next story, 70% of Boise home sellers dropped their asking price in July. We talked about this already last week, but that is becoming, more rampant across the board and across other states and areas, but more particularly in states and areas where the boom really hit hard. Prices just skyrocketed in a lot of these places. So Boise was one of the number one. It's also right now the number one overpriced market. So that would explain why they're 70%. But other places, even in our area here in Florida, Tampa, 52% are over are dropping their prices as we go down. Miami, 18.5%. Miami has really cooled down quite a bit, so that's not really any shock there. Next one. This is something we have been talking about too. The what's been going on with the Fed and their rates and how they plan on moving forward. What they plan on doing with those rates if they're going to continue raising them. The 10-year Treasury bond, as I've been mentioning, that's something to keep an eye out. It did recently climb back up to over 3% just yesterday. So that was Monday. So while the future of the markets are really starting to price in the a Fed pivot in the future, they don't think that the Fed is going to continue raising the interest rates or the Fed rates. That narrative is now starting to come back where they think there's going to be a bigger pivot, which is something I've been mentioning quite a bit to keep an eye out on. Because if they do pivot and they start to go to easy money again, that is going to probably start to either lower the mortgage rates further or even drive prices up further in the market. But one of the other sides of this is that a lot of people are starting to hold off on all sides of real estate. Buyers are starting to hold back even more. Sellers are holding back from even listing their properties, which is why we're starting to see inventory decrease a bit and not come on as strong as it has been over the last couple months. And then on top of that, rent. A lot of renters are even pulling back and saying, we're not going to rent. They're finding other ways around it because prices have just increased so much. I think it was 30% rental prices have increased. When you look at the average wage increase of only 8%, it's 3 times more. So how do you expect people to stay up with it? So, in addition to that, we're also starting to see foreclosures and evictions for renters tick up quite a bit, quite drastically. So that means a lot more inventory is going to be coming to market, and that's going to lower prices and demand as well for those pieces of property. So, but this particular article is more of an opinion. Wishful thinking by the markets has led to a much anticipated Fed pivot in the first half of next year. This stands in sharp contrast to the Fed's own rate projections, which is saying that they're going to continue raising rates possibly into towards the end of 2023 and get that up to almost 4%. So, we'll have to see what plays out and how it plays out. But, these are really just things that we need to keep an eye out on as far as the stories and what actually happens, which again is really, in the market, you kind of have to do it as it comes. So it's not something that you can really predict because, again, a lot of this data is based on lagging indicators and you can't really make really great predictions based on lagging indicators. It really has to come from something leading, which we have been talking about and we'll be talking about in the last story a bit too. Chinese banks. So this is something I have mentioned last week, but Chinese banks are inflating their loan numbers as demand sinks. And the scary thing about this is it reminds me of 2008 quite a bit, the way they're doing it. Chinese banks are employing unusual practices, which is what we saw in 2008, but in this case, they're not doing it necessarily to consumers, but they're doing it between bank to bank. So in order to pump their more credit into the economy, from the lockdowns, state-owned banks are extending loans to companies and then allowing them to deposit funds at the same interest rate. So they're really just swapping. And then as far as borrowing, they're borrowing from each other. So banks are borrowing from other banks, which makes it look like the economy is doing great and that there's demand for these loans and lending. But if a bank's swapping for another bank, it just looks like it is, but it's really not. So that's causing a huge concern over there. Companies including Schneider Electric SE has received loan offers from a dozen banks at record low rates, but has no plans or needs to borrow given the cloudy outlook. They're seeing that everything's slowing down. So they're like, why am I going to borrow money that I have to pay back when I know things are slowing down even more? And then especially they're not considering borrowing because their cash can fully cover their operations and the modest growth. So why would you take out any more? Just to kind of put this in perspective, this graph shows the divergence of M2 money supply, which is basically the supply that the government is releasing into the economy. When that goes up, you need to have more people borrowing money in order to keep that economy going. Where you see the red line actually going the other way now, it's decreasing. That's the financing growth. So in a debt-based economy, which is what the world economy is now, you need people to borrow money in order for that money to keep flowing around the world. If people stop borrowing money, then the economy starts to contract, and if it gets real bad, it can collapse. So, and then finally, this is the story that I think is, probably one of the most important ones, because this is something I've been questioning quite a bit over the last, probably the last year. The amount of data and the type of data we've been getting, is it really legitimate data, or is it cooked in some way? This article really tackles that and provides pretty convincing story and argument for it. Because we've been getting all this job growth, right? All this job data that's been coming out, that we've been growing, and we've been really just getting back to where we were before the pandemic. But now this new survey came out. It's actually showing that more than half of U.S. companies are laying off workers. So if you've been watching for any period of time, you already saw this graph right here. This is one that I already proposed, and this was 3 months ago. So these were all the layoffs that were coming 3 months ago. And since then, all these huge companies, decent number, not, we're not talking in the hundreds of thousands here, but this is just the big companies that are being tracked. Since then, it's actually gotten worse. More companies, more people are being laid off. You can see right here, there's a list of them. Number one, Ultratech, electric truck maker Rivian, which is, that's been in the news quite a bit. 7-Eleven, Shopify, Vimeo, Redfin, Compass. Compass is in huge trouble right now. They've had some really bad numbers come out about their company since they became a publicly traded company. They've been losing a ton of money, billions of dollars. So that's not good for them. Remax, again, a lot of these are real estate related companies, and manufacturers for automobiles, and insurance companies. Walmart, that's not good either. Obviously, Walmart laying off people. But the big surprising story here is the difference between what's being reported on the establishment survey, which is what we always get and talk about here in the news, how it's all the way up here in the green. And then you have the difference of what's being reported at home by the household survey. There's a difference of over 1.8 million jobs differential. And as I mentioned in the last week's video, one of the possible explanations is the fact that more people are taking on multiple jobs. So the people who are already working are now filling in a second, maybe even a third job or more. That's part of it, but I don't think, and this article kind of goes on to show you, it really doesn't explain how there's a $1.8 million 1.8 million job difference in that, the statistics and the surveys. So job changes March to July, you can see multiple job holders up 263 versus part-time and full-time. That's down. Both of them are negative. So the solid jobs market is one of the very few things that is preventing the Fed from substantially easing back on its hawkish policies. That's why this is so important, because if the job data is wrong and we are actually losing jobs month over month, just more people are picking them up, then they should already be starting to reverse course, because they don't need to continue at least raising rates, because they're already doing their job where they're at. However, if this continues to show job growth and the data is being manipulated, that gives them cause and reason to continue raising interest rates, which pushes our economy into an even deeper recession. So that's where this is really going to matter the most is, is this data correct or is it not? Because if it isn't, then they're doing the wrong thing right now and they're making things worse. What if it is intentionally being manipulated to make Biden's economy appear stronger than it is for midterm election purposes, even if it means distortions across the entire market? Again, it doesn't really matter which side of the political spectrum you fall on. That's a valid point and something that everybody really should consider, because it doesn't matter if it's Republican or Democrat who's in office. A lot of times the party who is in office is trying to make their campaign and look stronger for the elections coming up. So that's a point that really needs to be considered too. And again, this all goes back to the survey that was just recently done by PwC. which suggests that the true state of the job market is far, far uglier than the alleged 528,000 job gain reported from BLS in July would suggest. So again, you know, this is something that you just need to be aware of. It doesn't necessarily mean that this is what is happening, but I think it's something that you really need to consider and make sure you know are checking out other sources, not just whatever you fall in line with, but look at the other side. What are they arguing? What are their what's the data really suggesting? And do your research. Do your due diligence on it, and I think you'll be fine and be able to make a good decision. I'm sure many of you are like-minded and have similar beliefs to my own as to what's going on with the markets and economy. Otherwise, you probably wouldn't continue watching, but please make sure to check out some other channels that cover the stock market and economic news as well. And if you see a story that you think I should cover, let me know about it and share it in the comments or just reach out to me. I'm here for you all and want to make sure you're getting the info you and others like you need to know about to make better decisions moving forward. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools, resources, and hot lists. And if you ever want to connect or chat, my info is in the link as well. As always, stay safe and I'll see you in the next video.